Good morning and good afternoon for those of you joining us from across the Atlantic. My name is Mike Kolodner and I am Marsh's U.S. Power and Renewable Energy Practice Leader. Really excited to be hosting you here today. We've got a phenomenal set of panelists lined up to offer some truly unique insights on what's happening here in the U.S. and a bit of stage setting. I'm sure all of you are aware of the magnitude of the investments being made in renewable energy infrastructure assets here in the US. The size, the scale, the volume, what we're seeing here is really an unprecedented amount of investment in these assets. And it's been going for a while, and many of you have been playing a role in that. Some of you are a little bit newer to the space. But the volume and the magnitude of all of this is really notching up and continuing to grow. So we thought it would be really helpful if we brought together a group of clients who are really stakeholders and leaders in this transition and in this this wave of investment. Most of you are dialing in from outside the US. Some of you are dialing in from the US. All of us are in this together, and a bit more background on the speakers and what we're going to cover here. So, from Marsh's perspective, we thought it would be helpful if we organize this session in a Q&A format. So I'll introduce the panelists in a second, but I'll let you know that we've provided some questions in a particular framework to highlight a couple of themes that we see, in addition to the foreign investment in the renewable sector here in the U.S. Questions related to challenges securing coverage, the elevated importance of mutualized insurance capacity, increasing scrutiny regarding natural hazards exposures, and the evolving market dynamics requiring really more mature risk management strategies in order to be competitive and effective. I'm going to go ahead now and introduce the panel. Our first panelist is Liz Burdock. She's the president and CEO of the Business Network for Offshore Wind, a nonprofit organization dedicated to building the U.S. offshore wind supply chain. Her initiatives and career are singularly focused on convening and coordinating diverse stakeholders, including businesses, academics, government agencies, policymakers, community leaders, workforce organizations, and strategic investors to develop sound solutions that facilitate the implementation of clean energy in the United States. We're excited to introduce her to you today, and we're really grateful for her leadership. Tom Kane is Vice President and Renewable Energy Product Manager at Aegis, where he's responsible for all renewable energy insurance products, including operational property, builder's risk, and excess liability. In a career which truly tracks with one of our themes, Tom began his underwriting career at the MGA G-Cube before moving on to lead the U.S. renewable energy business for Axis Capital. His appreciation for where this sector has been and where it is going is really second to none in the underwriting community, and we're truly excited to have him on the side of Aegis's members and insureds during this critical time. Rob Hale is the London market leader for the only truly globally integrated power and renewable energy practice, with responsibility for placement strategy in the London market on behalf of all of our clients globally. He joins us from Aon, where he served as leader of portfolio solutions, overseeing structured solutions in electronic trading strategy following a term as head of their power and renewable energy practice. I can't tell you how excited we here at Marsh are to have Rob join our team. And as a former risk manager and client of Rob's who relied on his leadership and insight, I can attest to his exceptional skill, vision, and expertise. We couldn't have a better resource advocating for clients, helping us remake dysfunctional markets and setting the bar as respects transparency and alignment of interest. Spencer Hunsberger is Managing Director of Credit Suisse in the Global Markets Division based in New York. He heads the energy asset finance business, focusing on power, storage, and grid solutions. And his insights on the financing of renewable energy assets is informed by stints at Bank of America and Barclays, and we couldn't be more appreciative of his generosity and willingness to share them with you today. Anthony Joyce is a Senior Vice President in Marsh's U.S. Power and Renewable Energy Practice and co-head of Marsh's Tax Insurance Group, specializing in renewable energy tax strategies. He brings considerable experience and expertise to our team and to clients leveraging tax incentives and tax equity to finance their projects. Consistent with our focus on industry specialization, his insights on this critical element of risk management come from an exceptional career spanning over 20 years in the sector at Bank of America, Macquarie, and Ernst & Young, among others. Ben Roberts is a Senior Vice President in Marsh's U.S. Power and Renewable Energy Practice. with accountability for offshore wind commercial development, onshore renewable advisory, project management, and strategic due diligence in support of private equity mergers and acquisitions for our clients. He's also helping to stand up our Center of Excellence in Boston. He joins us from ESAI Energy, where he supported oil majors, governments, traders, financial institutions, logistics companies, and others with economic consulting designed to improve their competitiveness and their strategic decision-making. Finally, Matthew Yao is Director of Lloyd Warwick International out of London, a global loss adjuster. Matthew's areas of expertise include HVDC transmission assets, rotating machinery, renewable energy, specializing in offshore and onshore wind and solar photovoltaics. Over the last 15 years, he's worked on over 17 gigawatts of installed offshore wind capacity alone, handling some of the largest and most complex losses across Europe, Asia, and North America. Those are our panelists here today. Tried to move through that quickly. A couple of quick logistical items before I get into the questions. There is a Q&A function at the bottom of your screen. If you scroll down, you can see it. If you've got questions based on the comments that are offered from panelists, feel free to put them there. Hamish Roberts, who leads our global practice, and I will do our best to curate them and make sure that we move through the questions as quick as we can so that we've got time for Q&A at the end, as well as some closing remarks on the themes and on where we're going. So my first question, getting right into this, is for Liz. And we've had a major change of events here, a big election, as most everyone's aware, in the U.S. And so I'll start with the easy question, Liz. Just your perspective on, with the change of leadership in Washington at the national level, what are the most immediate impacts that colleagues on this call should be aware of for the offshore wind sector in 2021?
Well, great. And I want to say thank you for including me. I feel very honored to be here with you all today and with this really distinguished panel. The sun is coming up, so I'm sorry that there is a glare on my camera, but I hope you all will deal with that. Before we really talk about the change in leadership, I do want to take a really quick step back. You all were aware that at the end of the year, the 30% investment tax credit was extended to 2025. This was a huge achievement, and I want to point this out because it really did exceed industry's expectations, but it points to the growing awareness that there is on Capitol Hill for offshore wind. We had a really hard time for many years getting them to understand the distinction between onshore and offshore. So this really does point to that they now understand that offshore wind is a unique industry that deserves its support of its own. So we had that happen. And then we had, obviously, President Biden was sworn in on January 20th. And I think some of the immediate impacts that you're going to see from the new administration, you've already started to see them. You saw that Vineyard was put back in the front of the queue at BOEM. We have a new administrator there after having the chair empty for 4 years. So we now have a political director, a political appointee in that chair, and someone who is very familiar with offshore wind. So her leadership, combined with the additional $5.1 million that they received in funding to help staff up, to really clear that backlog of projects that they have for approval, I think you're going to see those move. We saw one of President Biden's first actions was his executive order that called for the doubling of offshore wind. So that EO really does give BOEM the directive to advance the current 11 projects that are in the queue, increase transparency and predictability in the permitting process, and also have more frequent leasing and leasing expansion. Before I close, I do want to say that I actually think that the U.S. offshore wind market is bigger than what people are projecting right now. I know that we have 30 gigawatts that states have agreed to procure, but I think it's somewhere in 150 gigawatts is actually our market size. The reasons why are the executive order that we have from President Biden, but the fact that 10 states have actually passed 100% clean energy legislation or are going to be carbon neutral by 2050, they're starting to work on those roadmaps to a carbon neutral future. And they're seeing that they're going to need much more offshore wind than they had originally expected. We know that Massachusetts is looking at something like between 14 and 16. New York is saying 9 gigawatts is the floor. New Jersey is calling for more offshore wind. So that, coupled with the presidential leadership, President Biden's going to convene leaders on April 22nd for a climate discussion, where I think he's going to push corporate America into actually expanding their corporate commitments to reducing climate. So I think that eventually corporate PPAs will push the market to a larger size as well. So again, I think that the market is actually, and by 2023, I think it should become very clear that we're in a triple-digit market here in the United States.
Thanks, Liz. Just following on that comment a little bit, can you talk a little bit more about some of the things we're seeing at the state and local level? I think some of our guests on this conference have less familiarity with just how diverse policymaking can be at the state and local level, and we're definitely seeing heightened levels of state and local engagement and influence with respect to those portfolio standards, as you mentioned. And as I think about it, ratepayers are more than just voters. They're customers, they have opinions. Do we see differences from state to state with respect to the appetite for offshore wind procurement, but also investment in the supply chain specifically?
We do. I mean, you have states such as Maryland that only has a 1,200 megawatt commitment, where you have, the neighboring state of Virginia at 5,200 megawatts, which is, it's amazing to see Virginia move so quickly and with such a large offshore wind commitment. And then, of course, you've got New York with the 9 gigawatts. What we're seeing is that the investments in manufacturing and workforce development and ports and infrastructure are following the procurement appetite. So the states that are making these large buys and stating that they will are also supporting those procurements with infrastructure investments or workforce development investments, R&D investments. I have a map or a chart, which I will put in the chat, that will show everyone exactly the amount of public sector investments that we've seen over the last 4 years to support offshore wind. So I think that is important, because you absolutely, they now understand that they can't just set up projects without putting all the infrastructure that is needed around them.
Thanks, Liz. And this next question is kind of a joint question for Liz and also for Matthew. As the industry continues to develop here in the U.S., how important is it to state and local leaders that developers actually utilize local content? And from your understanding, do professional and financial service providers qualify as local content?
Do you want?
If you want to go ahead and start, Liz, and then Matt, we can go to you.
Well, I mean, I think, you said it before, ratepayers are voters. And when you're making these public sector investments, with their dollars, there needs to be returned to them. So it is really important from a state's perspective that there is the local development of the supply chain. But I personally think that it's bigger than that. The market's changed dramatically over the last 5 years. And what we're seeing is a global market expansion. I believe that there's something like 1,400 gigawatts are expected to be installed and operating by 2050. And, GWEC estimates that we're going to need 1 million workers by 2030. And so as the global market expands, we're already seeing shortages of workers and supply chain companies. So we're going to have to develop a local supply chain here in the United States if we want our projects in the water. And I really believe that is what is going to lead to local supply chain development more so than the state mandates, because the market is going to require it. And we're going to need more, European companies jumping in with investor-owned utilities and, U.S. and other U.S. utilities and JVs to really help bring about the amount of offshore wind that we're going to need to meet our clean energy goals here.
Matt, your thoughts?
And from a claims perspective, I mean, what we've certainly seen is the requirements of local content in European wind farm. So essentially what happens is a lot of structures could be manufacturers designed in UAE, but they'll be shipped and finished off in, say, Northern Ireland. And that would then therefore make that project eligible to meet their local content requirements. But that's an additional interface risk. You know, if you're producing materials and equipment in one place, shipping them somewhere else and finishing them to hit those requirements, that adds additional risk. And that's something that, you know, stakeholders need to be aware of. It certainly hits those local content requirements, but it does add an interesting aspect in terms of that interface.
Thanks, Matt.
Michael, I didn't completely answer your question. You asked financial and insurance companies counted as local content. Absolutely, they do. That's the way we understand it. Yes, of course.
I appreciate that, Liz. I was about to drag Ben Roberts on to give us an opinion on that, so thank you. All right, so we'll come back and we'll touch on some of these related topics again, but I want to move now, if I can, into this other theme around the importance of mutualized insurance capacity. And those of you who know me know my background. It's a particular area of interest for me, and for those of you who currently own, are contemplating ownership / membership, right? These are companies, mutual companies are owned by their insureds, and it's a different source of capital, even to the extent that they use or may use reinsurance capital to support them. Each mutual is a little bit different. Each membership base has different goals and objectives. And I'm really excited to ask Tom a couple of questions, because I think that's one of the things that makes the expansion into the US really different than what we've seen to date in the renewable sector is the awakening of mutualized capacity and solutions and insights. And we couldn't be happier to have Tom here with us today to talk about that, since he's really at the forefront of it. So for Tom, for those attendees on the line that may not be familiar, can you provide just a quick introduction of Aegis, but mutualized capacity generally, and with the amount, as far as the question goes, with the amount of growth forecasted both onshore and offshore in the U.S. and particularly among Aegis's members, what are Aegis's plans for involvement, and do you see the membership base in the core constituency evolving over time?
Sure. Yeah. Thank you, Mike, and good morning, good afternoon to everyone. Yeah, I think, as you alluded there, I think probably you've got more experience than the mutual insurance companies than I certainly do. I joined Aegis 6 months ago now, so it's kind of a relatively newer concept for me. And my background prior to that was on the commercial insurance side. So mutuals are certainly more prevalent in the US than they are in Europe. They of course do exist in Europe, so I'm the concept's there. So I fully expect most of the audience to be aware, of the model. But I think it's probably good for me to give a sort of brief explanation of the mutual concept. So in essence, a mutual insurance company is one that is mutually owned by its policyholders, opposed to a stock insurance company, which is owned by its stockholders. And I guess the principal idea is you avoid any potential conflict of interest. Perhaps you avoid the short-term financial interest of the stockholder. You don't get that mixed up with the long-term interest of the policyholder. And it brings off obviously quite a few benefits. Probably the most obvious one is that capital, that profit, if there is any, can be returned directly to the policyholder, and that is usually in the form of dividends or credits. Now, mutuals are often set up for specialist industries. You get like-minded businesses pooling together, and that's ultimately what Aegis is. Aegis is one of a few of the mutuals with members involved in the North American energy industry. So our policyholders, represent pretty much the vast majority of the U.S. energy infrastructure. So we're electric and natural gas utilities, oil and gas exploration and production companies, transmission and distribution companies, for example. Now, for me, a kind of major benefit of the mutual model is really that aggregation of, probably one for a better word, of experience, aggregation of that knowledge, and really the kind of mutual collaboration, the mutual sharing of that knowledge. So Aegis, for example, we have a very, very robust loss control team. We have close to, I think, 60 engineers on staff, which for a 300-person organization is a relatively large proportion. That engineering team certainly assists on the underwriting side, and I found that very helpful. But they also assist in loss control advice to our membership, and very much sharing insights collectively on particular technologies, OEMs, and of course loss trends as well. In terms of the renewables, so Aegis has obviously identified the need, to meet our membership needs on the renewable side, and they did that some time ago. But has made significant investment recently with the hiring of my team on the underwriting side. We've made investments in modeling capabilities specific to renewable technologies, and of course on loss control as well. I think where we see the space, I mean, like everybody else, we obviously recognize a huge amount of investment coming into the industry. I think it's a rapidly evolving space. So that that mutually sharing of ideas, mutually sharing of experiences is almost it's imperative really in such an industry which is which has that sort of evolution, rapid evolution.
And Tom, just to highlight it a bit, because it's membership within Aegis is something that is some here may be considering. How does that work exactly? I mean, so and do you see new members joining Aegis? Do you see new policyholders over time? Just as the investments kind of come in and as folks set up shop here, is that something that Aegis is contemplated and thinking about and kind of prepared to support?
Yeah, very much so. Historically, and I think the charter was sort of built on two very key products. Back in the 70s, it was formed together because of the shortfall in the casualty excess, liability in that market. So that really is a core product, as is the D&O. And those are kind of the kind of membership criteria buying one of those products. But reality is we have multiple products, and the idea is you buy. The idea is we want members to buy as many of those products. So I referenced the mutual model returns some of that profit to the policyholders through credits. I mean, one of our biggest sort of one of a better word, what makes our business very sticky is all those credits, and they come in the form of either loyalty credits or continuity credits, and that is often linked to buying multiple products. Speaking to that personally, right now we of course write business which is non-member business, and from my background being involved in the U.S. renewable market for some time, we have brought insureds to the mutual already, and they've expressed an interest in sort of becoming members. They have come in as we're looking at their property risk and writing their property risk, but we are exploring the opportunity to bring them in on the excess casualty side and other products there as well.
Thanks, Tom. That's fantastic to hear, and I think it's tremendous. We can't say enough. It can be a really difficult thing, I think, for mutuals to evolve. I mean, part of the value that they bring is stability, and I know everybody at Aegis is working really hard to make sure you guys are prepared to support your membership base. So thank you. just kind of a follow-on question. I'm going to bring Rob Hale into this one, if we can, a little bit. And Rob, you've actually made markets. You've created solutions for clients. This is not something that's new to you, but doing it in this environment, and thinking about the current risk capital distribution system for renewable energy. The only way I can come to describe it right now, to be honest with you, is it just doesn't seem to be aligned with the interests of the industry that it serves. And what I mean by that is, if we look at who benefits from increasing rates, if we look at the movement of ESG capital and all of the growth in renewables, the one area that seems to be not just lagging but running a bit counter to the initiatives and the things that ultimately are in the best interests of seeing a growing and vibrant industry, is unfortunately the insurance market. So as you think about that, what is it that what are we talking to our clients about? What can risk managers be doing to assist in recalibrating and kind of better aligning the interests of the insurance market and the insurance industry with the renewable industry that it's trying to serve?
Yeah, thanks, Mike. And you mentioned earlier the dramatic shift that we've all seen in capital investment from traditional generation now towards renewable energy. But unfortunately, that investment has not been reflected by parallel growth in the insurance sector. So I think for a long time now, the renewable energy space has been made up really by two types of insurers. You've had one, the hyper specialist insurers, and two, the MGAs. And rather than capital being distributed, it's been concentrated into a very small number of vehicles. So the MGA domination of the market meant that apart from a very small selection of specialists, the insurers were giving their pen to the MGA vehicles and effectively outsourcing expertise. So I guess the knock-on effect of that we've seen is it's created a knowledge and capabilities gap across a lot of the insurer side. Not all of it, but obviously apart from those specialists. So the industry grows, but obviously insurers have not. In fact, up until recently, renewable capacity and lead options in the market have actually started to contract. We're seeing light on that now with the emergence of new capacity coming out. We've obviously got mutuals, which Tom just talked about, now looking to write non-member business. We've got traditional oil and gas companies now looking to transfer their capital from the sectors they're in towards offshore wind. So I guess really the question of how to align to capital, it's really down to the appetite of the risk managers and how they see the business modeling out over the next 5 years, and then who's going to be relevant 5 years from now. Certainly the model that we believe in and that we think will be most relevant 5 years from now is not the MGA model, it's the distributed capital model.
Thanks, Rob. That's fantastic, and a question for both of you, really, and feel free to take it in whatever order you guys feel comfortable. But you've both got perspectives on how renewable energy infrastructure is insured in Europe, what's usual and customary, but also in the U.S. and as it continues to evolve, what are some of the things that should be kind of top of mind for those coming into the U.S. market, growing in the U.S. market with respect to risk allocation and insurance? I mean, what's different? What lessons learned are out there, and what types of things should we be considering as we essentially make the marketplace, or remake it for the benefit of those that are investing in this space?
Yeah, happy to go first on that, Rob. Well, I just clarify, I haven't worked in the European market for about 10 years now, so I'm probably not that current. But my old organization, we were part of a global team, so we did get insights into that. I think I think a couple of things. I think the tax equity finance and the structure of how the insurance is bought here has been, you talk about the sort of limiting factors of why there hasn't been a huge amount of investment in underwriting or insurance companies making investments in that. I think one of the off-putting things for insurance companies has been that ultimately how the insurance is being bought. And I think that kind of element of the project company itself has to stand on up on its own, and it has a financial model, and that financial model has to pay for the insurance and has to pay for the deductibles. And those have been often created in a time when the market was very soft. Insurance market was very soft, and that put off a lot of capital providers on the insurance side. I think tackling that beast for a lot of European investors is one thing, and I think there's probably people on this panel who can speak more to that. But from an insurance perspective, buying those very low down deductibles and very high limits is challenging, especially when, as Rob was saying, that capacity is contracted. I mean, just from a basic, Europe versus here, I mean, the nat cat is a huge component. Yeah. These are projects which are inherently prone to the weather, and the U.S. has a lot of nat cat. It kind of, be it sort of big aggregated events like earthquake or named windstorm, to much more isolated storms, and in between these winter storms we're seeing in Texas. There's a lot to contemplate on that, and really, the focus needs to be on designing, some resilience into these projects. I think that's kind of the key thing for me.
Thanks, Tom. Rob, any thoughts on this? I mean, what are some of the things we should be thinking about from a lessons learned perspective, and what are some of the things that you're doing, specifically to whether it's reducing barriers to entry or just really trying to make sure we've got high functioning competitive market dynamics?
Well, I think, from the market perspective, unfortunately, there's been and it's a bit of a ding on the brokers and insurers. There's been complacency in the space for some time now. We mentioned earlier the over-reliance on MGAs, and in fact, this is left a capabilities gap that I mentioned before. There's also been an over-reliance on a small number of specialist leaders in the market as well. And so, I think the responsibility here lies with the broker really to be continually developing market and looking for where future capital is going to come from. In the past, a lot of the business has been held by a small number of brokers, and maybe capacity has not been developed in the way that it could have been. So I think at the moment, we're looking very closely at how we can fast track market development. We're working with partners across the energy sector, the reinsurance sector, property construction, and also with clients, really to educate new entrants into the space, or even players who are looking to convert capacity from one area like oil and gas and bring it over to the renewables side, and just articulating risk exposure, risk profiling, portfolio balancing, and what's needed to lead and follow. So I guess, good news on that is there is more capacity coming in from a number of different areas. We've got the expansion of conventional power portfolios into renewables. We've got transition of onshore and offshore energy coming into this space. Alternative capacity options are coming in for Hale in solar and other cat aggregation issues. And then obviously we've got the benefit in the US space in particular of the mutual capacity. And then finally, I guess the other piece of significant capacity that we've seen entering the market is coming in particularly from the larger oil and gas companies with the captive participation, which is obviously a significant amount of capacity coming in.
Thanks, Rob. I'm gonna shift gears again here and go back to I got a couple questions here for Matthew and for Liz. If we look at the overall immaturity of the U.S. offshore market and the U.S. supply chain, things like the lack of specialty vessels, can you share some insights on claims experience, Matt, and just some lessons learned there?
Yeah, so what we've seen in the claim space is a vast range of costs. So the average claim value, this is Europe and US, is about $3 million. If you damage an array cable or an export cable, that can range vastly between $2 to $30 million. The question we asked ourselves was, why is there such a big range? The $2 million loss, that's the one that occurs during your CAR, during summer. You have contractors on site, vessels on site, spares available. Fine. The $30 million loss is the one that occurs in your M&D or in your operational phase. Contractors or vessels are demobbed. You're basically subject to the spot market, invitations to tender, and those prices. It's supply and demand. So if you have a limited fleet and everybody's, keeps their occupation of these vessels, the utilization very high, generally contractors do not like to see vessels and things sitting idle. It's not earning the money. So that means that they charge high mob, high day rates. And that is something that the supply chain really will have to take some time to catch up with. And that's what we saw in Europe 10 years ago. I mean, we have a much more developed supply chain now, but certainly for the US, this is going to take some time. Otherwise, you're going to end up with your sort of Swiss Army knife approach, whereby you basically trying to use the same platform to do multiple scopes, and that's going to increase repair costs and duration as well.
Liz, as we think about this kind of area and this general subject, the Jones Act is a particularly unique challenge that I think a lot of the folks here are familiar with. It's something we've talked a lot about, but what are you seeing or hearing in terms of building out U.S. vessels to support the industry? How long do you think it's going to take us to have sufficient resources to really support the growth that you're projecting?
So, sort of in our inventory right now, we have 3 CTVs that are capable of working and that have been built and are capable or Jones Act compliance. There's one that some people don't know about, but it's a WinCat CTV. But so that we include that in our CTV fleet. We've got 2 more being built. Obviously, everyone knows about the Dominion Energy investment into a wind turbine installation vessel. There was the announcement of Eversource and Ørsted's service operation vessel. And then we have Great Lakes Dredging that's made an investment to build a rock placement vessel that is Jones Act compliant. So that's essentially what we have right now in the books. But I am hearing about a lot of vessels, contracts being negotiated, just as we're speaking right now. So I expect to hear many more announcements in 2021 about vessels and vessel builds specifically for the U.S. market. I think that, once you get a record of decision on Vineyard from BOEM, that's really going to turn the spigot on in the vessel building industry in the U.S. So to answer your question, I think I will not have to answer a Jones Act question in 2023. I think that's probably will be the end of the Jones Act questions that will be coming my way. So, but back to Matthew's point, I mean, cable installation vessels are another area that falls outside Jones Act, and we've talked a lot about framework agreements and taking lessons, best practices from the telecommunications industry and moving those over into the offshore wind industry to deal with cable repairs and making sure that those vessels are available when those cable damages occur, and we all know that they will in the U.S. market. It's not something that we will be immune to. So I think that's something where you all can have a lot of influence on how that bottleneck problem gets solved.
I mean, we've seen Ørsted join ACMA, which is part of the that framework agreement, but you really need a critical mass of projects to make it beneficial for you to join a framework agreement whereby someone is saying, I will keep a vessel on standby, ready and waiting to go and perform your repairs. I mean, that's a lot of expenditure. If you're just installing 1 or 2 projects, you're not going to have the balance sheet for that. But if you have 30 operational projects, then it makes sense. Absolutely keep a vessel on standby with a cable, a universal joint. Yeah, you can certainly sort of bring down the repair time, but you need that critical mass.
Matt, just focusing the question a little bit, and I think cables present a great example for a couple of different things. We've talked previously about things like exchange rate risk and choke points in supply. And as we're thinking about what we've already learned from the advancement of onshore renewables, where we've had things like manufacturing facilities built in one location, and as technology has advanced and blades have gotten longer, those facilities have been outgrown, quickly, and we've had to adjust, and I think we're starting to see the same thing in the supply chain in the offshore space. But generally speaking, can you offer some comments around what you're seeing around supply, from what are some of the risks that we need to be thinking about, here, both on availability of supply, repair, replace vehicles, but also that exchange rate question?
Yeah, I mean, FX instability is certainly one. I mean, we've seen in recent months a reserve fluctuation of 10%, and that could be $1 million in just from a European contract and the US dollar denominated policy. So that's a huge swing for any claim, and that's purely FX driven. I think on the supply chain question, absolutely. The driver for renewable energy is technology. When I first started in an industry, the 3 megawatt was a workhorse, and everyone was installing a 3 or 3.6. Nowadays, there's nothing smaller than 9.5 megawatts going out in the seabed. And the reason for that is purely, you can drive down the cost. The levelized cost of the energy is lower if you can eke out more resource from Mother Nature. But with that comes that design risk. And certainly when we're pushing larger and larger turbines, different cabling technology going from 33 to 66 kV, there's inherent risks in that. They are remote, they are remotely monitored, they're unmanned. The chances of defects manifesting in damage are higher in say, the offshore wind sector. And thus, I think a lot of emphasis and focus needs to be put on these contracts, making sure they're robust, especially in the hardening market where availability of leg 3, for instance, in cables is a thing of the past. And simply, leg 2 just does not work for cables. It offers little to no design related cover. So making sure we don't have gaps between contractual warranties in supply only contracts and your insurance policy, making sure that, you have that kind of seamless transition between the two. That's going to be critical, and understanding the serious loss clause and what it may or may not do, I think is entirely a very important subject as well, which we could probably spend an entire presentation on, but for this purpose, yeah.
No, yeah, I think, and I know, one of the things from a practical standpoint, Rob, do you mind just offering, one perspective on, how can we address some of that risk on the front end? I mean, how can we, as we're thinking about exchange rate risk and some of the challenges with these projects being supplied in part or in whole from different geographies and the different players and the attributes of it, anything we can be doing on the front end?
I think it's down to working with the insurers from an early stage might come in there. These aren't the first construction projects that have been put into the market with global insurers or where exchange rate issues are in play. It just, they're obviously offshore, which complicates things. But I think it's working with the insurers from an early stage to understand all aspects of the exposures and building that into the planning phase of the project.
How important is consistency of coverage terms in this context, in your opinion?
That's very important, I think. And I think we've seen a lot of inconsistency in coverage in the last few years. And that's something that we're very focused on in future placement, is aligning the policies to make sure there is consistency. And I'm sure that's something that Matt probably sees huge complications when we come through to a claim and you have inconsistencies in the policy.
I want to take the opportunity, this subject of the again, we've got non-U.S. companies investing in U.S. assets. Each individual investment is going to be a little bit different. But Spencer, just pivoting a second here, we were chatting about this yesterday to some degree, and I guess if we think about it with projects that have U.S. dollar denominated revenue, U.S. dollar denominated debt, and diverse supply contracts that could have European or sterling pricing in addition to kind of the long timelines associated with these projects. I mean, what's your sense? Do we really have a full understanding of all the exposures that are embedded within these projects from a financial perspective?
It's a good question. Thanks, Mike. And good morning, good afternoon. Let me just say any opinions or mine don't reflect Credit Suisse necessarily, but look forward to discussing this. Do we understand the full picture? I think we have a pretty good understanding of what the risks are going to be, and the panel has talked about a number of those so far today. But the timeline point is somewhat unique for lenders, investors who have been coming to the space from what's been principally for them a U.S. invested market or U.S. lending market to date. And that can mean a couple of things. One, on the lending side, it's a different form. Most of the banks that are going to be lending to these large products, when you think about the New England offshore wind tenders, they're used to full wrapped EPC, right? They're just looking to one party that's usually creditworthy, that puts a bond behind their activity, and it's a pretty simple construction to term lending program. What we know from the first part is it's going to take more of a European model, where it's a collection of different subcontractors, and how you fit those together and how you think about making sure there's no gaps between the pieces and they talk to each other, and that insurance is wrapping the individual silos, so to speak, of work is going to be critical as these principal U.S. lenders to date come into U.S. offshore. Now, that being said, when you look at the bank group that has been named around some of these projects, it has international flavor to it, right? So we're not just talking about large U.S. banks. There's a lot of large European and Japanese and French banks that are going to be leading this activity here. So that's not new to them. But if you're talking to a U.S. risk department, that piece of it might be something to consider. The second piece of the component, and I think it was Rob or Tom who mentioned earlier, just the implications of tax equity here. If people on the call don't know about tax equity, that's probably a whole separate panel. But these products are going to be funded with tax credits or subsidized with tax credits. The sheer dollar scale of the credits is enormous. When you think about an ITC, a fair market value based credit, and the scale of the build out that Liz and others have talked about here. And so you have two questions, and one is just the sheer dollars amount they're going to be required, and that translates into sheer amount of tax that U.S. investors would have to be paying to offset these investments. But to your question, Mike, on timing, that tax capacity is hard to forecast 1, 2, 3 years out. And that's what you're asking tax equity investors to do here for the first time. Because the construction lenders don't want to come to a project that tax equity is not going to be standing behind it. So then you have to say that tax equity is on the hook to make an investment in 2 or 3 years. Well, what if we have 2008? What if they don't have taxable income in that year? We haven't seen an issue so far in the products that have been talked about in the public market because there's only a few of them, right, that people have actually made commitments to. But you get to a point where we're talking about $5-10 billion a year of investment. It's something we need to monitor and make sure that it doesn't become a roadblock, and that the concerns in one piece of the capital stack, tax equity and solving for that, become concerns in another part, the construction lending market that is really underwriting to the tax equity takeout.
Spencer, we talked yesterday a little bit about the knock-on effects of what's happened in Texas. One of the other things that I'm personally concerned about, which I think it's is also going to wind up being highlighted, I think, by some of this, from a knock-on perspective, is just insurance and cost of risk as a function of operations and maintenance expense. I mean, we're just seeing it's much larger in renewable energy investments than we see in other assets, and so the volatility there is has an outsized impact on the valuation of projects. I'm thinking about those two events, Texas, large losses, and the importance of insurance. What's your perspective on what's keeping you awake at night, or what are you thinking about in terms of potential adverse consequences given what's happened? How does that ripple through the market? Are we going to have enough tax equity? What are some of the things that folks should be thinking about in terms of beyond just the event that happened? I guess is really
that's the $1 million question, to the billion or $10 billion question when you look at the scale of the issue in Texas. My view is that Texas is not going to be isolated. It's isolated in terms of the events that led to it, the structure of the power market there. and the particular off-takes that those projects use, both on the renewable side and the conventional power side. But again, you have to think about crossover concerns in the investor and lender base. And that's two ways. One, think about a large tax equity team at a large bank. It's just a fixed number of people. And if all of a sudden 10, 20% of those people are spending their days trying to solve questions that are coming up in Texas with a lot of uncertainty, even before you crystallize losses, just uncertainty and thinking through what could be the implication. Do we need to get ready to make a member loan? Do we need to think about talking to our sponsor proactively? Do we need to call the hedge desk that we were working with? It's just time away from new deals. And that's always going to be, when you're in any large bank, that's going to be a fixed sum game. People can only work so hard. So that's point one. And then point two is anytime you highlight a risk to a risk department that people didn't fully understand, that's going to then come into new projects, right? So if someone says, well, we kind of understood shape risk in Texas and weather risk, but we thought about that in like August and September. We didn't think about it in terms of hitting in the middle of January and February. What don't we know about offshore wind? The question is, it's Rumsfeld's rules, right? It's the unknown unknown. And now there might be some more kind of crossover known unknowns in terms of renewables underwriting. So I think those two things are a big consideration. And what's the solve for both of them? A refundable tax credit. So if there's anything that sponsors, investors on this call should be championing with the people who focus on policy within organizations, it's a refundable tax credit. Because it doesn't mean the tax equity investor goes away. It just means that they don't have to be a bottleneck to the development of the supply. It means that good tax equity investors will still be there. Getting from monetizing 85% of the credit as proposed now to 100%, that's still worthwhile. You should still bring in an investor to do that. But it means you're not waiting for that person to build your project. It means you can price it differently to get the refund and move forward, or move forward with more certainty, or move forward with underwriting it to a construction lender base or otherwise. And so that does keep me up a bit at night right now, as much as anything does in this space, is just thinking about how do you square those two things, these incredibly ambitious targets from a build perspective, and then just what does that mean in terms of tax capacity in the US market. ITC is great because it's FMV based. You don't have production risk on it. The downside to that is it hits in 1 year. So all of that demand is not going to be spread out like the way it is on a PTC side. And you say, okay, well, maybe we'll elect offshore wind into a PTC regime. Well, I don't think so, because the lending structures that we're seeing from the banks right now are more predicated on an ITC investment, where you don't have a lot of production uncertainty that then has knock-on consequences into the term bank market. So this need for tax equity is the main big difference in the U.S. market versus the rest of the world market. Counteracting that is a point that one of our clients said to me 5-6 years ago when he started acquiring offshore leases in the U.S. And this is the best way to think about this market. And he said, Spencer, the story of offshore wind in Europe is that we put the bad technology in the good areas. And then by the time we had the good technology, we had the bad areas. You're building stuff 100 miles offshore. He's like, why am I buying up US offshore leases? Because now I get to put the good technology in the good areas. And it's super simple when you think about it that way. We are totally standing on the shoulders of all the work that's been done in the rest of the world over the past 2 decades. So that's the big positive that we should take away from this. And then all the stuff on finance, we just need to figure out. There's different tools to figure it out.
Thanks, Spencer. And I'm going to note, conscious of time right now, I just want to do just a quick rapid fire, rather than ask a specific question. If we could just go through each of the panelists before I turn this over to Hamish for closing remarks. As you think about the comments and the questions that have been out there, 1 to 2 sentences, 30 seconds apiece. Is there a message that we want to make sure folks who've been listening in on this conversation take away from your particular perspective? And so I'll go ahead and I'll start with Ben Roberts. You've been very patient, and I know this is not your thing, sitting patiently on the sidelines. So can you give us 2 sentences, 30 seconds? What's an important piece to take away here?
The main thing I think that I've heard throughout the panel is just that there's an incredible opportunity obviously for increased renewable energy infrastructure in the United States and offshore wind specifically. And I think also there's a lot of questions and challenges in how we navigate these waters that we find ourselves in. And so the biggest thing that I came away with is just the importance of engaging advisors early, engaging insurers early, and navigating these questions together.
Thanks, Ben. Anthony, you've also been quiet, and I appreciate that very much. But I guess the question here, same thing from your perspective. We didn't get to spend as much time on it as we hoped, but you know, any comments or perspectives you want to offer?
Yeah, sure. So, you know, I'm focused on tax insurance, which has been used, at least in the onshore market now, for you know, for a decade or so, and we're excited to see how that will play out when we get to the activity in the offshore market. But the comment that I did want to make, just kind of playing off Spencer's comments on tax equity, is when tax equity is looking at the financing against the tax attributes, it's the developer or the sponsor that is really standing behind the majority of the tax risk. And for these large scale projects, just as that will be a challenge for tax equity, it is going to shine a spotlight on the credit quality of the balance sheet of the developer or the sponsor. And so while I would expect our attendees at this point understand kind of tax equity and financing structures in the US, what is not well understood is, to the extent that there is friction in discussions around financing that relates to tax insurance has been used in this market for some time to effectively eliminate that friction.
Thanks, Anthony. So Hamish, we've had a lot of conversation, a lot of dialogue. We've covered a lot of ground. As you've listened to all of this, I'm going to turn this over to you for closing comments, remarks, and your thoughts on this as you listen to this conversation.
Yeah, thank you, Mike. And indeed, thank you to all our experts who've really brought a complicated subject to light, but in a really simple way. Renewable energy is not new in the United States by a long way, but it's almost as if a starting gun has been fired with the change in regime at the beginning of the year. And I think that, as Liz says, there's going to be up to triple-digit growth by 2023. There's going to be a lot of activity. I think we're going to see the Europeans are coming. That's a phrase I've used, but also there's going to be a balance between long-term European developers' expertise mixed with US domestic developers as well. And I think we're going to see a lot of JV partnerships by the sounds of it. These projects are going to be very, very big. They're going to require a lot of funding, a lot of capital, and they're going to, the element of JV partnerships is going to be probably quite a new thing to consider and a little bit more complexity to manage. I think in terms of insurance and partners, Tom describing Aegis and the other mutual models, that's a sort of a slightly newish buying trait from some of the European developers. But the mutuals can bring a huge amount of knowledge and expertise around claims and policy issues. And as Rob has said, there's an awful lot of new capacity entering the renewable energy market, and there's going to be a balance between mutual and new entrant capacity, all at the same time where many insurers are considering the markets hardening. So I think it's going to be an exciting shift in style of insurers who are going to partner in some of these projects. Spencer's talked about how there's a potential bottleneck. The phrase used was a bottleneck of tax equity. And that what's happened in Texas recently might be not an isolated event that might happen again. I think that position and where the insurers can offload some of that risk might spread out. But I think there's going to be a bumpy couple of years whilst all these projects get financed, from the sounds of what Spencer says. And then Matthew, and not forgetting claims, is at the end of the day, after all, that's why everyone is buying insurance. It's for the claims. There's a lot to be learned from some of the lessons in the European models. These projects have complicated supply chains, which need modelling and need understanding from a claims recovery perspective. It's all about the cables. If you talk to Matt, it's all about the cables. Cables are very complicated, and that's a sort of a new science that hasn't really been been understood much perhaps in the United States so far. And then how many spare vessels might be put together in some sort of framework agreement. I think that might mitigate the claim a lot. But I think it's going to be, whatever's happening, it's going to be an incredibly exciting opportunity. I think it's going to bring out the best in developers, the best in the markets, and hopefully the best in brokers. I think this is a great opportunity for us to come up with some great solutions. And thank you all for your contribution and joining this event.
Excellent. Thanks so much. We do have a couple of questions that have come in. I've taken some good notes and we'll be responding to those. I would encourage, if you need contact information for any of the panelists that have participated today, please don't hesitate to reach out and we will make sure that we get you connected, and we hope you enjoyed it. Thank you so much, everyone.